For an investor planning on buying and holding real estate, would you recommend cost segregation? So this is interesting. So when you say investor, so I mean, we're buying and holding real estate, so that we're gonna, this is long term. So this isn't a flipper. Cost segregation just means this, and I'm going to write this up so you guys can kind of follow along. So if you have rental, and we'll just call it residential, single family residence, you write off the value of the house, the improvement on that property, over 27.5 years. So if it's, so let's say that you buy a house for $350,000, in the land value is $75,000. That means the improvement, the house itself, is worth $275,000. You would divide that by 27.5, which is going to give you $10,000 a year of depreciation. So that's standard depreciation. This is the modified accelerated cost recovery. So whatever that is, MACRS. And correct me if I get anything wrong, Jeff. You're the accountant.
I'm watching you.
Let's say that we have rents coming in at $10,000 a year. We just wouldn't pay any tax on it. And we're talking net rental. But what if we have net rent coming off of this of $30,000 a year? So we have $30,000 a year coming in, positive, minus the 10. That gives me total taxable income of $20,000. When does it make sense to try to jump this number, this $10,000 up? What if I could make that higher? And that's when you do the cost segregation. Because let's say I'm in the highest tax bracket in a state like New York, Connecticut, California, something with a high state tax, Baltimore, you name it, or Maryland. Baltimore's not a state. Maryland. I know people are making fun of me. I'm making fun of myself. $20,000, that's going to get hit pretty hard, in some cases 50%. So I don't want that $20,000 to hit me. Then I may look at this and say, hey, instead of looking at it and taking the traditional MACRS sense, I'm going to break this down into items that are less than 20-year property and the structure of it. So for example, if I walk into a house and there's a chandelier in it, that chandelier isn't part of the structure. I could break it off and write it off over a shorter period of time. Or there's heater covers, or, you know, everything from HVAC to your boiler to you name it, to your, you know, whatever's in that house, appliances, everything else, you break these things out. They're not part of the structure. And if I break those out, I can write those off right now with bonus depreciation all in the first year. And the rule of thumb, I'm just going to say rule of thumb is 20%, is about what you're going to get in that first year. So rule of thumb is I would get an additional, just multiply that by 20%. So what is that? $55,000. I would get an additional $55,000. So I wouldn't pay any tax on that. Let's say I'm making $20,000 a year. It would be a good 2.5 years before I'd be looking at a taxable event. And by that time, maybe I bought more property and I keep bonus depreciating. Now that's the classic sense of when you do a cost seg, is when you have either too much money coming in, or there's a flip side. If you have one spouse who is a high net income earner, so they're making a lot of money, one spouse is making a lot of money, spouse one, and spouse two can qualify as a real estate professional, and then you can create losses through the use of cost segregation to subtract from this. So you get a loss, so you can lower their income. That's the typical times when you're doing cost segregation. I hope that was in English so you guys could follow it. So whenever you're buying and holding real estate, it just becomes, what's your tax appetite? If you're already creating losses and you're just carrying them forward because you're not a real estate professional, and a real estate professional is when you hit 750 hours, it's your #1 use of time, and you materially participate in your real estate activities. if you hit those tests, then you could be able to take real estate losses and offset active income with your real estate loss. And Louise, you can do cost seg for both commercial and residential. It used to be it was just commercial. Now you can do it against a single family house. It was never cost beneficial before, but now you can get them done. I've seen them done for $1,500. So you get a big old fat write-off if you're doing the cost seg, and it's whether or not you can get the benefit out of it. So anyway, what about renting a condo which has window upgrades? Is this cost segregation? Probably not. It depends on what the value of the condo is, but yeah, you break it all down and say, hey, I just had a whole bunch of windows done. Yeah, maybe those aren't going to be 27.5-year property. That's going to be much less, and I'll probably get to write them off in the year that I did it. It all depends. All depends. So it's a little calculation that you do, but I could tell you that the bigger your tax appetite, the better. And then it says, if you become a real estate professional in a tax year, after you did the cost seg and carry over losses, can you write it off, or is it trapped passive loss? It's trapped if you are an investor before. Real estate professional is only for the year. Jeff, am I misstating that, or is that your understanding too?
No, that's correct. And the other side of that problem is when you become a real estate professional, you have to aggregate all of your real estate activities together into one activity.
Yeah, this is one of the most misunderstood areas where, and unfortunately, it's because we had a bad court case that came out, and they missed it. They didn't understand real estate professional, and whoever was convincing them, like, they were all wrong, and so the court was wrong. But there's two tests. There's the 750 hours, number one, use of your work time, which one spouse has to qualify for, and then, Jeff, we're going to put the cat cone on here. And then there's the, if anybody's ever been to my event, you know what the cat cone is, right? It's what anybody who's playing with their phone during it, we're just going to slap the comb of shame on them. So they can't play with their phone. But,
I don't know whose phone that was.
Yeah, blame it on one of the techs.
It was the dog. It was the dog's phone.
Anyway, I don't even remember where I was. I was blabbling about something. Probably some nonsense. Wasn't my fault, it's everybody else. All right, so I don't remember what we were going on, but that's probably good.
Wouldn't it even make more sense if it's commercial property? Because there you're looking at 39-year lives instead of 27.5-year life.
Yeah, absolutely, and you're going to get much juicier amounts when you have if you have a commercial property with $1 million and you're able to get an extra $200,000 write-off right now. And if you're never planning on really selling it, like you're going to hold it, maybe you're going to trade it for more real estate, you'll never pay tax on that cost seg. Like, all you have to do is eventually pass away and your basis steps up. So it's one of those things where if you just sit there and let it happen, test for the real estate professional. It's two requirements. See, I get lost. Sorry, guys. Blonde. All right. So you have the real estate professional, which either spouse can pass. And then you have the material participation in your real estate activities, which is a material participation is to combine the spouses spend 500 hours or 100 hours, and it's the most time spent on your properties than anybody else, or you did all of the time on your real estate, in which case we don't care about how many hours. So that's material participation, but that is per property. So when you do the material participation, it is per property unless you choose to aggregate it. If you aggregate all of your rental properties, then you just apply it to one. So let's say I have 10 pieces of real estate and I spend 50 hours on each one. And it doesn't matter whether it's me or a spouse because we add it all up together. But I would not pass the real estate professional test, even if I did the 750 hours, because you get 750 hours per year, but it's each property I would have to be either I'm doing all the management or I'm doing 100 hours total and nobody else is spending more on each property, unless I choose to treat them all as one activity, and then I don't. But I actually have to make an affirmative election, and accountants miss this, guys. You wouldn't believe it. There's court cases where people spent more than 700 hours, 750 hours, and they could show it, but then the IRS looked at it and appropriately said, but you didn't aggregate your properties. You had a bunch of properties, but each one you'd have to meet the hourly test. and they had management companies. So you're basically having to meet the 100-hour test on each property at least, or you do 500 hours total. You don't have to care. This is something that says, are you considered a real estate professional if you have a property management company? You still could. It's 750 hours and you materially participate. That's it. You don't have to, like, and it's 750 hours, but it's the number one use of your time. So it can push the 750 hours up. If you spend 1,000 hours in your day job, for example, but you spend 1,001 hours in real estate, then you would meet the real estate professional standard. But if you did 1,000 hours in something else and 750 hours in your real estate activity, you would not meet it because it's not your number one use of time. What if my day job is a real estate agent? Then as long as you're involved in real estate transactions, you're in the buying and selling of real estate, then it qualifies. So you would meet the 750-hour test. So we have somebody says, what if my day job is a real estate agent? This is a great example. Let's say that I have 3 rental properties and I want to qualify as a real estate professional. You would say, hey, they meet the 750-hour test. They may be doing 2,000 hours, but then they have to materially participate in their rental activities too. Somebody says, because that is what I did pass with the IRS. Absolutely. So you qualified under both tests. So you still have to spend time on your rental properties. So yeah, you guys are now jumping all in. So I love that. So people are out there packing this one.